You know you have to pay income taxes, but you don't really understand how it all works? Why do some people get a tax refund, while others have to pay more taxes when filing their return? Is it a good idea to earn more income, or are you just going to lose it all to more taxes? I answer all of these questions, and more, in today's video. Hi. My name is Kat and I'm a chartered professional accountant. On this channel, we discuss Canadian tax, accounting, and personal finance, with the goal of helping you keep more of your hard-earned money in your own pockets. Today's video is all about how income taxes work in Canada. We'll go over tax brackets, how taxes are calculated, including tax deductions and tax credits, a comprehensive example to take you through the entire process. At the end of the video, I'm going to share 5 tips to help you save as much as possible in taxes. So let's jump right in. First things first, let's talk about tax brackets since they are a big source of confusion for many people. In Canada, our income is taxed based on a progressive system using tax brackets. Each bracket contains a portion of income that is taxed at a different rate. For example, in 2024, income up to about $55,000 was taxed at 15%, while income between $55,000 and $111,000 was taxed at 20.5%. The higher the overall income, the larger the portion taxed at higher rates. Contrary to common misconceptions, it isn't your entire income that's taxed at the rate of the bracket you fall in. It's only the portion that falls within that bracket. The rest of your income is still taxed at the lower rates. We'll go over some examples in a second. First, I want to mention that each province also uses the same progressive system to calculate income taxes, but the brackets are different in every province. For simplicity, I'll only be focusing on federal taxes in this video, but just know that the same concepts apply to provincial taxes as well. Okay, now let's look at some examples to see how these brackets actually work. Let's say you earn $200,000 in 2024. As you can see, that amount falls in the 4th tax bracket, between $173,000 and $246,000. However, that does not mean that you'll be paying 29% in taxes on the entire $200,000. Your taxes will be calculated by taking 15% of the portion that falls in the 1st bracket, plus 20.5% of the portion that falls in the 2nd bracket, and so on. So only about $26,000 will be taxed at 29%. The 29% is what we call your marginal tax rate. It's the rate at which every additional dollar you earn is taxed. Let's look at a more detailed example. Let's say you earned $50,000 in 2024. The full amount is below $55,000, so it falls in the 1st tax bracket, which means that your entire income is taxed at 15%. $50,000 times 15% equals $7,500 in taxes, leaving you with $42,500. But what happens if you get a promotion and you now earn $60,000? Well, $55,000 will be taxed at 15%, and the remaining $4,000 will be taxed at 20.5%, for a total of $9,227 in taxes. This leaves you with over $50,000 after taxes. So, with a $10,000 salary increase, you paid a bit more in taxes, but you also kept an additional $8,000 in your pockets. If you were under the impression that making more money is a bad idea due to additional taxes, that's not the case. Yes, you'll pay a higher tax rate on the additional income, but the amount left over will always be higher than if you hadn't earned the extra income at all. Now that we understand tax brackets, let's talk about how income taxes are actually calculated. I'm going to start by giving you a general overview, and then we'll dive into the specifics of each item in more detail. It basically works like this. You start by adding up all of your income sources for the year. This is your total income. Then, you subtract what we call deductions to get your taxable income. This is the amount that is used to calculate your taxes, using the tax brackets we just discussed. Once your taxes are calculated, you subtract tax credits to reduce your taxes owed. This gives you your net taxes payable. Finally, you compare this amount with the taxes you already paid throughout the year, via deductions on your paychecks, or installments you made to the CRA. If the amount already paid is less than what you owe, you'll have a balance owing. If what you paid throughout the year is more than your net taxes payable, you'll get a refund. Now let's break down each item, starting with total income. Basically, any income you earn, from any source, except if it was within a tax-sheltered account such as a TFSA or RRSP, is added to your total income. This includes employment income from your job, investment income, such as interest and dividends, taxable capital gains, rental income from any real estate property you own, self-employment income from your business, employment insurance as well as old age security, and so on. By the way, if you'd like more information on tax-sheltered accounts or capital gains, I've linked my videos about these topics in the description box below. Next, let's talk about deductions. A deduction is an amount which directly reduces your income. This is different than tax credits, which I'll explain next. Common deductions include RRSP and FHSA contributions, moving expenses, and child care expenses. For example, if your income for the year was $50,000 and you made an $8,000 contribution to your FHSA, you could deduct it from your total income, bringing it down to $42,000. The $42,000 becomes your taxable income, which is used to calculate your taxes via the tax brackets, as we saw earlier. Next, let's go over tax credits. Tax credits are used to reduce your taxes rather than your income. They come into play after your taxes have been calculated using the tax brackets. Most tax credits are calculated by taking the credit amount, multiplied by 15%, which is the same rate as the lowest tax bracket. For example, everyone gets the basic personal amount, which was $15,000 in 2024. To calculate the credit, we take the $15,000 and multiply it by 15%, which gives us $2,250. That $2,250 can then be deducted from your tax amount. There are two types of tax credits, non-refundable and refundable. A non-refundable tax credit can bring your taxes down to zero, but never lower, so it doesn't create a refund. For example, the basic personal amount we just discussed is a non-refundable tax credit. So, if your taxes for the year totaled $2,000, they would be reduced to $0 using this credit. The remaining $250 is lost. On the other hand, refundable tax credits are paid to you regardless of the taxes you owe. Refundable tax credits include the Canada Child Benefit, the GST/HST credit, and the Canada Carbon Rebate. Last, let's discuss how you get a tax refund, before going over a comprehensive example. Before we go on, if you've learned something so far, please take a second to give this video a like, it really helps the channel. Alright, so as mentioned earlier, you need to compare your taxes payable with how much taxes you already paid throughout the year. To get a refund, you have to have paid more taxes during the year than the amount calculated when doing your tax return. If you're an employee, your employer will have taken deductions directly off your paychecks all throughout the year, based on your salary. If you don't have any other sources of income, there shouldn't be a big difference between the amount you owe and what was deducted. In fact, if you claim deductions and credits, you're likely to end up with a tax refund. If you have more than one job, you need to make sure you don't claim the basic personal amount more than once by correctly filling out the TD1 form when starting a new job. Otherwise, you run the risk that not enough will be deducted from each paycheck and you'll end up with an amount owing when you file your taxes. If you're self-employed, you can make payments by installments throughout the year to ensure that you don't have a huge lump sum to pay come tax time. You might also be required to pay installments as an employee if your net taxes owing were greater than $3,000 last year and in one of the previous 2 years. So, the bottom line is this: to get a tax refund, make sure you pay enough taxes throughout the year and maximize your deductions and tax credits when filing your return. Alright, it's time to go over a comprehensive example that takes us through the entire process, from total income to refund or balance owing. Let's get started. This is Robert. Robert has a full-time job which pays him $160,000 per year. He also owns a rental property which earned him an additional $10,000 this year. His total income for 2024 is therefore $170,000. Robert has RRSP deduction room available, so he makes a $20,000 contribution to his RRSP. He claims the full amount on his 2024 tax return. This brings his taxable income down to $150,000. It's time to calculate Robert's taxes using the tax brackets. The first $55,000 of his income is taxed at 15%, for a total of $8,380 in taxes. The next $55,000 is taxed at 20.5%, for a total of $11,453 in taxes. Finally, the remaining $38,000 is taxed at 26%, giving us another $9,949 in taxes. Robert's total taxes amount to $29,782. Next, let's use some tax credits to lower that amount. Robert gets the basic personal amount, just like everyone. So that's $15,000 times 15%, or $2,250. Since Robert is an employee, he also gets the Canada employment amount. For 2024, the amount is $1,368. Multiplied by 15%, we get $205. Robert's total non-refundable credits therefore amount to $2,455. This brings his net taxes payable down to $27,327, which is still a pretty big sum of money. Luckily, Robert's employer deducted income taxes directly from his paychecks all throughout the year. The total amount deducted was $32,000. Robert will therefore be getting a tax refund of $4,673 because the amount of taxes he paid is higher than the amount he actually owes. Alright, now that we've gone over how income taxes are calculated in Canada, I'd like to give you 5 tips to help you save as much as possible in taxes. First, invest your money in tax-sheltered, registered accounts, such as the TFSA, rather than in unregistered accounts. Any income earned within registered accounts is not taxable. This means you don't need to include the amounts in your total income for the year. Second, maximize your tax deductions by making contributions to your RRSP, especially when you are in a higher tax bracket. These contributions can be deducted from your total income, reducing your taxable income and therefore your taxes. Third, maximize your tax credits by keeping your receipts for all eligible items, such as medical expenses, home accessibility expenses, tuition fees, donations, and so on. You can find a list of all available credits on the CRA's website. Fourth, if you're a first-time home buyer, take advantage of the FHSA, which has tax-deductible contributions like the RRSP. And don't forget to claim the home buyer's amount, a $10,000 non-refundable tax credit. Last, do some basic tax planning before the end of the year to avoid wasting deductions and credits. For example, if your income is $20,000 and you make a $5,000 contribution to your RRSP, you'll bring your income down to $15,000, which is equivalent to the basic personal amount. This will basically bring your taxes down to zero, and you'll lose any other non-refundable tax credits, such as the Canada employment amount we saw earlier. A better strategy would be to save your RRSP contribution room for when your income is higher, allowing you to use up all of the non-refundable tax credits you're eligible for. Planning ahead allows you to prevent these types of costly mistakes. So there you have it. We discussed tax brackets, how taxes are calculated in Canada, including tax deductions and tax credits. And we went over a comprehensive example to take you through the entire process, from total income to refund or balance owing. I also shared 5 tips to help you save as much as possible in taxes. That's all for today's video. I hope you found the information helpful. Don't hesitate to ask your questions or submit special requests for future videos in the comments. Be sure to hit that notification bell if you want to be the first to know when a new video is released. Thanks for tuning in, and I'll see you next time.